going to go into the issue of proceeds, base cost, valuation date, value, all that kind of stuff. That's sort of general that we'll leave there. And let's just focus on the small business asset exclusion. All right. Now, the small business asset exclusion is essentially saying that if you qualify for this exclusion, okay, because you're selling assets of a small business, when you sell those assets, just like when you sell any other asset, you would have to take proceeds minus base cost, gives you capital gain, right? And then we're saying 1.8 million rand of that capital gain can be tax-free, disregarded, take it out, just like you do with your primary residence exclusion. You take that off, but of course the key thing is, how do you qualify for it? It's quite a difficult exclusion to actually qualify for. First of all, that 1.8 million is a once per lifetime. All right. So if you sell a series of different businesses, the maximum exclusion you get, it's not per business, it's per lifetime. Now, what qualifies? Well, when you look at paragraph 57 of the 8th schedule, it's got the 3 different types of sort of assets that would qualify. Active business assets of a sole proprietor. All right. And in fact, I must just not leave out the words there of a small business of a sole proprietor, because in paragraph 57, it actually talks about what is a small business. I'm just going to get this paragraph up here so I can tell you about that. But small business, I'll probably come to it just now, but small business means a business of which the market value of all the assets at the date of disposal does not exceed 10 million rand. So if you've got a sole trader, sole proprietor, who's carrying on a small business, and this term active business assets is also defined, which we'll come to just now. But the point is, to qualify as a small business in this context, the total assets must not exceed 10 million rand. Okay. So it could be a sole proprietor that sells his whole business, obviously as a going concern in that context, all right? Or it can be an interest in active business assets of a partnership that qualifies as a small business, again, upon that person's withdrawal. So you've got one person pulling out of the partnership, but the actual partnership must qualify as a small business, so total assets mustn't exceed 10 million rand. And the third one talks to a company. So if you've got shares in a company and interest in a closed corporation, as long as the individual sells his entire direct interest in that company, to the extent that the interest relates to active business assets of a small business, again, so the company must qualify as a small business, and what you're selling is your interest in that company relating to the active business assets of that small business, and you must hold at least 10%. So you must hold at least 10%, and you must sell your entire interest. So if you hold 15% in that company, you must sell the whole 15% in order to qualify. All right. So it's basically those 3 disposals. So sole proprietors, partnerships, interest in a company or closed corporation. But then there's more requirements, okay? You must have held that asset or interest continuously for at least 5 years. So you've got to plan for this in advance. You can't go out and buy a little franchise, and then 2 years later sell it. You're not going to benefit from this exclusion. You've got to hold it for at least 5 years. You must be substantially involved in the business operations during that period, and it's intended as a retirement benefit, basically. So you must have attained the age of 55, or you could be younger if you're selling because of ill health, other infirmity, or the person might have died. Maybe the owner of the business has died, 35 years of age, all right? Potentially, as long as all these other requirements are met, in the estate, well, probably, sorry, in the tax calculation for the deceased person, you would then work out this exclusion. And then another requirement, okay, as I say, this is anything but simple. All capital gains must be realized within 24 months of the date of the first disposal. All right. So if you're selling off different assets and you want all your sale to qualify for this exclusion, all of those sales must take place within a 24-month period. So you can't sort of do this ad infinitum over a long period of time. So I mentioned the definition of small business. 10 million rand is the threshold there. Active business asset. Now I actually just want to give you the full definition here. When we talk about active business asset, it talks about an asset constituting immovable property to the extent used for business purposes. All right, so you might have, let's say, a sole proprietor who has his own business. He's using fixed property for business purposes. The immovable property, to the extent used for business purposes, would qualify as an active business asset. And then an asset other than immovable property, they must be used wholly and exclusively for business purposes. All right. So again, it gets a little bit technical there. If you've got motor vehicles, stock, furniture and fittings, etc., those assets will only count as active business assets if they're used wholly and exclusively. Immovable property, to the extent used for business purposes, and it excludes financial instruments, etc., and the 10 million rand on the small business. All right, so it is quite a useful exclusion. The 1.8 million is quite generous. Unfortunately, it hasn't been increased for a couple of years, but it is quite a generous exclusion. Of course, quite nice if you'd otherwise have to pay tax on the taxable value of that 1.8 million. And so it is worth having a look at. Yes?
Sorry, I just want to ask, when you said the capital gain must be realized, if the person buying is paying it off, but the capital gain has all been included in one tax year, is that acceptable?
Yeah, that's fine. So if there's a payback period, but you actually conclude the sale, but there's a sort of a loan that you've granted and the person must repay. But so that date of disposal, the disposal happens when the sort of ownership transfers, etc., even though repayment might happen at a later date. So you must have just made the actual disposal, yeah. But that means that you've got to recognize that capital gain in that year of assessment, yeah. So the only thing I wanted to illustrate with this example from the SARS Comprehensive Guide to CGT is where, I mean, we've got here Elias, who has a fleet of 5 taxis, etc. I know taxi is not always a good example to use in Joburg. Just when you're about to go out and face all the taxis on the road there. But anyway, I mean, this could be anything. It could be plant machinery, different types of assets, etc. All right. The point is that he's reached the age of 55. He's been substantially involved in the operation of the business. He's got assets in the business. He's had this business for 8 years, so he's met that 5-year requirement. And now he's going to sell these assets as a going concern, lock, stock and barrel, for 700,000 rand. 200,000 relating to goodwill, 500,000 relating to the taxis. Now, just an important point that comes through in this example is that although he's selling this as a going concern, it's not the sale of one asset, because he's selling 5 taxis and he's selling goodwill. So he's actually got 6 different assets there. So when you work out the capital gain, you would have to establish for each of those assets, is it an active business asset? And what is the capital gain on that asset? And are you going to qualify for the small business asset exclusion? All right, so you can't just sort of do it as one globular whole. You've got to look at each asset separately. So if we look at the solution here, they list each of the taxis. Now, this could be different items of plant, furniture, whatever it might be, all right? Initial cost, capital allowances, how much you're receiving for each of those assets. And then you'd have to do the calculation separately for each one. So we've got the capital allowance, base cost, consideration. Now, in these first few assets, 0 base cost, but you're getting consideration. So obviously whatever you get is recouping your past allowances, because in all cases your consideration is less than your original cost, or in this case it's equal to. All right, but for the last 2 taxis you've got a base cost of 90, get a consideration of 160, so you're recouping the 60,000 rand there. Here you've got a cost minus capital allowances gives you a base cost of 200,000. You're getting consideration of 250, but your original cost was 250, so again that's all recoupment. So an important aspect here is don't forget about the Section 84A recoupment, because you've got to first recoup your old wear and tear allowances, so that whole recoupment becomes taxable. There's no relief for that. The relief is on the capital gain. Now, what is interesting is there is no capital gain on any of these assets. All right, so we're not looking at the primary residence exclusion there, but we have also sold goodwill. And there, it didn't cost him anything for the goodwill, so his capital gain is 200,000, and he can disregard that as part of his small business asset exclusion. Just a point that if taxis 4 and 5 had been sold above cost, the resulting capital gain would not have qualified for the exclusion, because they have not been held for a continuous period of 5 years. So you've got to just be careful of that. It's all very well to say he was involved in the business for 8 years. But you've got to look at each asset separately. Did he hold each one of those assets for at least 5 years? Only the ones that he held for 5 years, had there been a capital gain, then you would qualify for the small business asset exclusion. All right. But these two, let's say take this taxi here. If you had sold this taxi for 350,000, made a capital gain of 100,000 on the sale of that, that would not qualify for the small business asset exclusion because he hasn't held that asset for at least 5 years. So it's a trap that people can often fall into. You kind of say, I've been running this business for the last 15 years, therefore everything I sell should qualify for the exclusion, but you've actually got to look at it on an asset-by-asset basis. Okay, so just be careful of that. So as I say, it's a nice exclusion, but it's a bit of a minefield when you get into actually making use of it. So my suggestion would be just look very carefully and try and get somebody else to also just have another look at it so that you get that exclusion correctly applied and correctly calculated. Yes.
He's just selling his shares in the CC.
Yes.
His total holding. You don't have to go into the assets if he's had those shares for longer than 5 years.
Okay, so if he's selling the shares in the CC, and to answer that, I think it's worth just having another look at what the legislation actually says. So it says the entire direct interest in a company to the extent that the interest relates to active business assets which qualify as a small business. All right, so he must have held his interest for at least 5 years. All right, and as long as what he's selling is his whole interest, and that relates to active business assets. All right, so if that company has investments and active business assets, you might have to split. All right, but as long as it's all trade related and it's all active business assets, then yes, you would be able to take it on the whole amount. But it really is quite a complicated exclusion. Yes, yeah, farmers would. Obviously, you have to look at how the farm is held, etc., etc. Yeah. So he sells his farm, and then basically, farmer, taxi driver, same approach. So he's selling different assets. Again, you'd have to identify what are the assets that are being sold. Has he held them for at least 5 years? Must sell them all within 24 months, etc. Yeah. Yeah, no, but same story, yeah. So it's got to qualify as a small business, it's got to be active business assets, got to meet those qualifications, you've got to sell them all within the 24 months, and if you tick all those boxes, then you would get the exclusion, yeah. Okay. Right, let's go on to the next. So, yeah, liquidation and winding up. I'm not going to spend a lot of time on this because essentially liquidation, winding up is talking about whether you've got your company, it's coming to the end of the company, you're going to liquidate or wind up that company. And obviously you've got shareholders who hold shares in that company or a member's interest in the CC. If you liquidate the company, obviously the shareholder or the member is disposing of his shares in the company. So there is going to be a CGT implication, there would be dividends tax implications as well. I just want to alert you to paragraph 77 of the 8th schedule that says if the company is wound up, liquidated or deregistered, the person, the shareholder, we now talk about a holder of shares, he's deemed to have disposed of all the shares held in that company at the earlier of dissolution, or in the case of liquidation or winding up, the date that the liquidator says there's going to be no more distribution from that company. So you don't wait until this company eventually, ceases to exist. These rules tell you that you take a stand and say, we have now got a disposal of those shares, work out the capital gains tax and declare that accordingly in your tax return. Okay, the example that I've got here, I'm going to just highlight a couple of main things. I'm not going to go through this example from top to toe, as it were, because it's going to take too long to go through all the ins and outs of it. But what I just want to highlight with this example is that if you have a balance sheet of a company and you're just about to now wind up this company, yes, we've got that deemed disposal rule that says you're deemed to have disposed of all your shares, etc. But apart from that, if you've got certain share capital and reserves on your balance sheet represented by cash in the bank, and you wind up this company, you distribute all that cash to your shareholders. You have to bear in mind that you'd have to analyze what is actually going back to the shareholders, because some of it will be a return of contributed tax capital, as we were talking about earlier, just a return of what they paid in for their shares. Some of it might be a loan. Maybe there's a credit balance on the shareholder's loan and you are simply repaying that loan. Obviously, that would have no tax implications. And there might be profits, retained profits, sitting in the company, which you are paying back to the shareholder. Those profits would be a dividend. So essentially, when you make any payment back to the shareholder, you first of all pretty much eliminate a repayment of a loan. That's not going to attract dividends tax for sure, because it's just repayment of the loan. It's not even going to attract capital gains tax because he's getting back what he lent. All right, so it's all square. But then when you look at what's left after repaying the loan, you paying back CTC, which is not a dividend, and then the balance of what you're paying back is a dividend. Now, in this case, the company made a capital profit from the sale of land, had to pay CGT on that. It was left with after-tax profits, if you like, from the property sold in the course of the winding up. And so at the end of that, if you took the profits left after CGT, and the loan and the contributed tax capital, we would say that there was 925,000 rand sitting in the bank account. Now, we want to pay that 925,000 back to the shareholders, but obviously you can't just pay that whole amount back, because you need to work out how much of that is a dividend. So we're saying of that amount, the 99 is just a repayment of the loan. The 1,000 is repayment of CTC, not a dividend. The balance of 825,333 is a dividend. You'd have to withhold 15% dividends tax and only pay the shareholder the net amount, and the balance must go to SARS. Okay, so that's really just the only point we're trying to illustrate with this whole example, is to identify what is the amount going back to the shareholder, how much is a dividend, and how much is a return of contributed tax capital. So the shareholder situation, they're getting the 1,000 back as a return of contributed tax capital. Let's assume that this shareholder was not the initial subscriber of the shares. They bought these shares from somebody else along the way, and they paid 501,000 for these shares. Now they're only getting 1,000 rand back. So obviously in their capital gains calculation, they're getting proceeds. That's what they're getting back from the shares. They deemed to have sold those shares on winding up or liquidation. They paid 501,000. Let's assume that is their base cost. They've got a capital loss of 500,000. And the question of whether that capital loss will be allowed links to other complexities in the 8th schedule that I don't really have time to go through. But you would have to look at paragraph 19 to establish what is the amount of the exempt dividend. In this case, if it was nil, then your capital loss is limited to the amount that exceeds any exempt dividends, etc. So paragraph 19 is an important one to look at. Just be careful of that. But what I really want to highlight here is just this issue that you have got the disposal. You would have to work out your capital gain on that disposal. Okay. Value-added tax registration, deregistration, just to go through these rules fairly quickly. The new registration rules on value-added tax are actually not that significantly different to what they were previously, because we still talk about the 1 million rand threshold, but what is required is if you think you're going to cross that 1 million rand in the ensuing 12-month period, it's no longer a case of do you think you're going to cross it. You'd have to have a contractual commitment that you're going to go over it. So you've got a contract that says my taxable suppliers are going to go over 1 million rand over the next 12 months. That would push you into the compulsory registration category. Otherwise, there is the voluntary registration, and they have tweaked that slightly, although we still have the 50,000 rand threshold. But what we're saying is that if you have a business with taxable suppliers less than 50,000, they haven't reached that threshold yet, they can still register, but only on the payments basis, which is not necessarily a bad thing, because you only raise your output tax when you get your money from your debtors. But of course, the other side of it is that you only claim your input tax when you've actually paid the amount. All right. So to be on the payments basis, not entirely bad. Just be careful, though, on that previous slide with the monetary amounts. If you are registered on the payments basis and you have an invoice of more than 100,000 rand, that's deemed to be on the invoice basis. So it's just a little complexity that you have to worry about. They could affect the timing of your VAT liabilities. But of course, if you had an invoice of more than 100,000 Rand, it means you've gone over the 50,000 in any event, which means you could then switch to the invoice basis. Okay. You can stay on the payments basis for taxable suppliers up to 2.5 million Rand if you qualify for that. And if you don't reach your 50,000 within 12 months, then SARS can deregister you. So it just gives people a chance to get in the door if they do want to register. But of course, if nothing happens with the business, then